presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for April 23rd, 2021. I'm Moe Ansari, President of Compak Asset Management, the Chief Investment Officer, and also host of Market Wrap. I appreciate all of you tuning in on a daily basis, where I do a one-hour market update on a daily basis every day. You can get the podcast, or you can listen live on the radio, on the local radio stations. You can get the app by going to the App Store and downloading it, and when typing in Market Wrap with Moe Ansari at the App Store, and you can download the free app, and you can get the daily update absolutely free. I'm going to talk about the pandemic a little bit. That's sort of going to go to the background over the next few weeks and months. I think it's going to fall more and more to the background, and then I'll talk about the U.S. markets. We want to talk about the Biden tax plan that rattled the market yesterday, and then we came back up today, and obviously the technical analysis. So let's start with a pandemic update. What's going on with the pandemic? You can see the daily positive cases are coming down here. The death rate in the U.S. is coming down. But we do have a problem globally, where we're looking at India, where they have had more cases now. Globally, we're seeing more cases than we have ever since this pandemic started on a global scale. So that is something to be concerned about. India reported 314,000 cases today in India, and that is what is being counted. I'm sure the number is double that of the infections, and there is the double mutant variant out there, which is the Indian variant, or double mutant as it's been called, and that is even more contagious than the B117, which was the UK variant. You can see that the doses administered had been going up very, very nicely, 7-day moving average, that's what it is. And but we did fall a little bit over the last couple of days. We're getting to the point where we've got just about everybody that wants to be vaccinated has been vaccinated, and now it's available to anybody over 16 that if you want a vaccine. And pretty soon, by the middle of May, the expectation is that we'll have more vaccine than we can use, and obviously we can use that as vaccine diplomacy, as it's been called, and try to help Europe and then other countries across the world. But that's what we will see where we go. But first, we've got to get everybody vaccinated here and get people who are a little bit hesitant right now. This evening, we did see the J&J vaccine could be coming back on the market, even with the few blood clot and the side issues that we have. They might put a warning on it, but I think that will be available also. Weekly count of deaths and excess deaths, you can see that has come down below the number upper threshold band of excess deaths. So we are below that now. So anything above that is bad, and we were above that. That's out of the norm, and below that is just normal. We are looking at the inpatient bed occupancy. You can see that again, way down. That is here in the United States. We are getting to a point, and I had said once the vaccine gets out, probably by May and June, we should be at a point where we will have a normal economy that's working. The question that we have to ask is, with the U.S. vaccinated, with China also growing dramatically, they reported some very strong economic numbers. So did we today. You saw the IHS numbers that showed great numbers on the economy here. We saw home sales, the highest number of home sales, new home sales since 2006. So the economy is starting to roar. I talked about roaring economy last year, and here we are getting to that point. But the question that I'm asking and thinking about now, can we continue growing at this rate without Europe reopening? They are starting to get there. They need to get their house in order as far as the vaccine is concerned. Can we do that? And with the rest of the world, India, Asia, having a resurgence. Osaka, the second largest city in Japan, closed down. They're shutting down again because of the spread of the virus. There's talk about canceling the Olympics again. So those are things that we need to think about. Can the U.S., I think initially we can, because there's so much pent-up demand here in the United States. We have pent-up savings that we can use, but that's for the next 6 months or so. We have to have the entire world working, reopening, not just China and the United States. I believe Europe will catch up, but the rest of the world we have to keep an eye on as far as that goes. We're looking at 215,000 doses administered that we've already administered. We're looking at Pfizer at 113 million, and Moderna at 94, and about 8 million for the Johnson & Johnson. Let's talk about the U.S. economy. One of the things that I've been looking at, you look at the top stocks, their valuations are way up there. But you look at the rest of the S&P, they're not as overvalued. And that's why we're seeing the broadening of the economy, where we're seeing the tech stocks slow down. And I showed you a chart last year where I looked at, look, if tech only grows 5%, the rest of the economy, or the top 5 stocks grow 5%, rest of the economy, or the rest of the 495 stocks in the S&P grow by 20%. What does that mean for the S&P? The broadening of this rally or bullish bull market we're seeing as it is broadening out now and I think the reopening stocks, which are mostly small cap stocks, could also catch up. Here's the small cap versus large cap. You can see that since September, the small cap has been doing much better. It had come down a little bit in the last month or so, but I think I'll show you the Russell chart. It seems like it is ready to also move up. And growth versus value, you can see that until September, growth was leading, value was lagging, and then it started to pick up a little bit, and then it accelerated at the beginning of this year, where value really, now we're at getting to the point where we are just about even in value and growth performance. You're also looking at the 10-year yield. The yield came down. That is the Lytle, and you saw the stock market come down. Stock market took off last year back on the recovery, and we saw yields sort of sit here for a period of time, but then last August it started to come up, and the yields have come back up also. But again, the yields are catching up. They went down together. Stock market came back up much faster. The yields are coming. I still expect the 10-year yield, which has pulled back from 1.75 to about 1.5. It's 1.56 today. I think we can get that by the end of the year. We will be at 2%. But 2% does not mean when I did the last week's YouTube update, when I did the quarterly update, which was a much more detailed update, I showed you the point where interest rates start to hurt the stock market. It is about 4.5% for the 10-year yield going back to the 1960s all the way up to now. But if you take from 2009, when we started doing quantitative easing and the Fed pushed the rates down, it is about 3.6%. That is the yield on the 10-year note, has to get to about 3.6% when it starts to have a negative impact on stocks. So yields can go up a little bit more. I think it'll create some anxiety in the market, but I don't think it puts the market in a bear market until we get towards the 3% number for the 10-year yield, and we're about half of that right now. So we have chance for the yields to go up a little bit, but I don't think they impact the stock market in the short term. Cause some volatility, definitely, but it doesn't cause that. Bitcoin, yeah, we're looking at that. Fidelity has filed paperwork with the SEC to launch an ETF, a Bitcoin ETF. We did see it drop over 200 billion in value over the weekend when there was some worry about it. And then the Biden tax cut, everybody talked about that, and it dropped Bitcoin below 50,000. I still think Bitcoin has become a category by itself. It's an asset class by itself. It's hard to understand the pros and cons on both sides of it. I think regulatory risk is the highest in Bitcoin. That is the biggest problem there. If the government bans it one day, that's the end of it. But with so many corporations and so many pension funds now owning Bitcoin, it will be difficult for the government to start just banning Bitcoin. When a digital dollar comes out, if it does, when it does, how will that impact it? But I think Bitcoin is here and it's here to stay. And we have to consider that as part of our portfolio. Small part, we have to look at crypto, and not just Bitcoin, but the crypto spectrum all across the entire spectrum, and look at that. The tax cut is what rattled, or the tax increases, the Biden tax increases rattled everybody yesterday in the market. The market was down, came back up today. I think there was an overreaction in the market. Yes, there are taxes that are going to going to slow the economy, slow the stock market. And I've talked about that last year when I said I thought they're going to keep interest rates low. That means keep monetary policy loose, but they're going to tighten the fiscal policy by raising interest rates. That is the brake they're going to use on the economy and the stock market to slow the economy down if it starts to grow too much. But we're not there yet, and the tax cuts are not permanent or haven't been put in place. When you look at some of them, they want to return the top tax rate to 39.6. Under the Trump tax cuts, it went from 39.6 to 37. Biden wants to return it to 39.6. That rate would simply take place in the current bracket, replace the 37 bracket. The top bracket would go up. That means approximately, if you make more than 520K, is single, or 620K. Social Security, they also want to raise that. Right now, earning more, if you earn more than $400,000, right now you pay 12.4%. Half of that is paid by the employer, half of that by employee on the first 137.7. What the Biden wants to do is raise that tax to another 12.4 on anything over 400,000, again to be split between the employer and the employee. So that's another thing. There's a lot of fine print in this tax that you really have to look at and think about. The biggest change that rattled the market yesterday was capital gains. If you make over $1 million in dividends and capital gains, it would be ordinary income. There would be no special tax. Also, he wants to reduce some of the deductions. Again, we are watching this very closely. Obviously, if you have an account with Compak, you have your financial planner that is aware, that is dedicated to your account. We have your financial plan in place. We can look at all of these things and how they will impact your taxes. We're not tax accountants, but we do a lot of work in figuring out the right tax brackets and how to minimize your taxes. That is one of the services that the financial planners provide to you. Also, he wants to change itemized deductions, and then he wants to change to the retirement contributions a little bit. And that's something that is in the fine print in the tax that they're trying to put in. I don't think they get Biden does not get everything, just like on the raising the corporate taxes, which he wants to go from 21 to 28. That came down from 35 to 21 in the Trump tax cut. So Manchin, who's the Democratic senator, and they need every single one of them to pass this, has said he will not go above 25%. The same thing will happen on the individual tax side. I would rather see the corporate taxes go to 28 rather than put in all of these other things that they're putting in for the individual taxes. I like to leave as much of the individual tax rates where they are and look at the corporate taxes. Looking at the technical analysis of the markets, 42.35 has been my target on the S&P. We are very close to that, closing today at 41.80, within an eyelash of the all-time high, which is 41.85. So we're very, very close to that. If we do get above that, then we could see an extension of the fifth wave, as it's called in the Elliott wave analysis, and that gives us a target of about 44.40. I don't know if we get there now. We get to 42.35, come back for the summer months, doldrums, tax, whatever issues people are worried about, and then we sort of rev back up somewhere in the fall. That I don't know if they'll come first, or the pullback or the sideways rolling correction will come. We do have support at the 20-day moving average, which is 40.94, and then the 50-day moving average, which is 39.76, and then the 200-day, which is 36.20 on the S&P. The weekly chart, again, points to we're in a third wave. Everything moves in 5 waves, 1, 2, 3, 4, 5 waves. And within each wave, you see these smaller waves, 1 here, 2, 3, 4, 5. This is the fifth of the fifth wave. And within each wave, you see these tiny mini waves within. So you can break these down, but the big numbers is what I look at, the blue ones, 1, 3, 4, 5. Once we get to 5, then we get an ABC correction, which we went through last March. Now we've started a new wave count on the weekly charts. Each one of these green and red lines is 1 week of trading. But here we are on the S&P, And if we do see an extension, that also points towards 44.75. 44.40 on the dailies, 44.75 on the weeklies. That's what it is. Support is at the 20-week moving average, which is about 4,000, and then 3,800. We need to see a fourth wave pullback before we start this fifth wave, but that could last, again, this before we get to 44.75, could be next year, because these are, again, this is about 1 year from here to here that we're seeing. All of this move is about 1 year since last March that we are seeing this move. So it could be a year before we get there. So it does not mean we immediately go there. On the NASDAQ, on the daily charts, we made a fifth wave top. We had an ABC correction, 1, 2, 3. Now we started a wave count to the upside, 1, 2, and 3. 14,175 is the intraday high. 14,080, I believe, is the all-time closing high. If we're very, very close to that, we have 14,016 or 17 today on the close. If we can make a new high, then the target on the daily charts becomes 14,750, and then an extension takes us to 16,000. Support 20-day moving average is 13.7, then 13.5, and then the 200-day moving average. Again, these are my views. Markets does what they want to do. The hardest thing is to get your emotions, your views out of the way and let the market and go along with the market without arguing with the market. Because guess what? The market is always right. As much as you might want to argue with it, the market doesn't care, does what it wants to do. These are the way I'm looking at the technicals. These are my opinions, the way I'm seeing that. Again, we saw the pivot point hit about 3 weeks ago. And these are little dots. When they're above the market is in a bearish mode. When they're below, which they are now, it's in a bullish mode. We went through this. I don't know if I can quantify this down move as a fourth wave yet. That's what I'm not sure, but we're starting the fifth wave. Will we see this as an extension of the third wave or a fifth wave high? We have to wait and see, but it also points towards 16,400. Here, this is a weekly chart again, going back to about 2018 or so. So this is a yearly chart, doesn't mean we get to 16,000 immediately, but that becomes the eventual target on the weeklies. Gold had a good week. As interest rates backed off a little, the gold market went up. I think there's a direct correlation. When 10-year yield goes up, gold goes down. When the yield comes down, gold goes up. I think long-term, in the next 6 months, I expect the yield to continue to move higher, or interest rates to continue to move higher as the economy continues to reopen. That, I think, will be a detriment to the gold market. But charts are looking better. We got above the 50-day, which is at 1747. Resistance now is 1858, which is the 200-day moving average. And then support is at this double bottom right here, which is at 1675. If we break 1675, then we go all the way back here to last April, and that is about 1600. And if we break below 1600, then we're looking at some numbers around here, which are around 1525 to 1500 to the downside. Will we go there? I don't know, but I would watch the yield to impact the gold market if you're in gold. I've talked about the emerging markets a little bit. Finally, we gapped up above this 50-day moving average, which is 54.35. Today we closed at 54.63. Seems like the emerging markets are starting to show they've gone through the fourth wave pullback or correction. This was the fourth wave, and we're starting the fifth wave to the upside. The target now, calculating from here, gives us a projection of about 62, which is about 20% higher, or about 17 to 18% higher than where we are now. So that could be a big move that we're looking at in emerging markets. Will it happen? We'll have to wait and see. But today, gapping above this 50-day moving average was definitely very positive for the emerging markets. Looking at the Russell Small Cap Index, here's a daily chart. Oh, I'm sorry, this is a weekly chart of the Russell. Again, we've gone through this pullback, came down to the 20-week moving average. We're starting to come back above it. We need to get above this high of 2360. That's where the all-time high is, and that will give us much higher targets of 2475 and even as high as 2800 for the small cap, but we really have to get fully reopened before we go there. That's the way I'm looking at it. Those are my views. Those are my opinions. That's the way I'm looking at the markets this week. I hope you had a wonderful, wonderful week. Have a great weekend. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.